Joining me on the program is Dave Morgan of the Morgan Report and Silver Investor. And Dave, last time we were on the program, we did a major show on how the silver price is manipulated. But I want to talk about something else that's an anomaly today, and that is what has happened to let's say, the silver producers, the silver stocks versus the price of silver. And what comes to mind, Dave, is if we go back to, let's say the summer of 2008 and 2009, where we had the price of silver was roughly in the $17 range on the day you and I are speaking. The price of silver is close to $33. And yet you take a large silver producer like Pan American Silver, its stock price is no further today than where it was back in the summer of 2010. So let's talk about that.
Well, certainly, being finance guys, Jim, and I'm not going to try to lose anybody, but there's this term sigma, and sigma talks about how deviated or how skewed a market is. So a standard deviation is quite skewed. 2 sigmas, there's even more skewed. And what it means is that in a normal market, is that the stocks follow closely to the underlying commodity, yet we're 2 sigmas off in the mining shares. And what that means is that these shares are extremely underpriced relative to their normal performance. Now, this stuff is really not that theoretical. I mean, it's a fact that they're very undervalued. Does that guarantee they're going to catch up? It doesn't guarantee it, but I'd say almost. So new money, particularly for people that already have their core positions in physical gold and silver, I think should really be looking at the shares. And, of course, it begs the question of, well, why have the shares underperformed so much? So, Jim, I'll throw a question back at you. Why do you think the shares have underperformed so much?
I think a lot of that, Dave, in my opinion, had to do with the risk-off trade last year because, we were worried about a double-dip recession. We had the Arab Spring spikes in oil prices, a hard landing in China, the possible dissolution of the euro. And so bullion, in my opinion, did better than the stocks. This year, it's kind of like, okay, the economy's improving, and all the stuff that we were worried about last year, we're no longer worried about, and so money's rotating into the equity markets. And if you take a look at, for example, technology companies are up within the S&P almost 22%. The NASDAQ is broken out, healthcare, materials, even consumer staples. And so it's like the market has such a short attention span. It's focusing on, well, we don't have to worry about this stuff anymore. And then I also think there's this myopic belief that the Fed has done money printing.
Well, I agree. I'd like to add on to that, though. My view is additional, and that is back in the last bull market, there weren't any ETFs available. So it was impossible for an equity fund manager that is required by law to only buy equities, it cannot buy a commodity, to purchase a gold or silver commodity. So they had to use the underlying mining equities. But with the advent of the exchange-traded funds, a equity trader, fund manager, managed money, pension fund, any of that stuff that's required to buy equities only can now buy an equity. They can buy an SLV or PSLV or any of the listed stocks and actually buy the underlying commodity directly through an equity. And that eliminates a lot of risk that these guys don't want to have, which would be geopolitical risk, mining strikes, possibility of mine cave-in, a labor dispute, all kinds of things that surround the mining industry in a negative way. When you buy the commodity, all that is gone. So I think a lot of the reason that you see the stocks underperform this time has to do with what you outlined, Jim, on the risk-on, risk-off trade, but I also think it has to do with the fact that there's an alternative equity investment that wasn't around in the last bull market.
I agree. There's a proliferation of bullion ETFs. But, Dave, let's talk about something that I know I got some input from the BMO conference where a lot of mining companies were very upset given where their cash flow and their profits have been, that their share prices haven't taken off. And a lot of these companies, from Newmont Mining to Silver Wheaton, are basically saying, look, we're going to return 20% of our cash flow to our shareholders in the form of dividends. And Dave, I never thought I'd ever see a company like, you take a look at, example, a well-known company like Newmont, which basically is yielding almost 2.7%, almost as much as a 30-year Treasury bond. They've raised that dividend 4 times in the last year. raising dividends at an annual rate of 25%. So do you think, in your opinion, if they continue to do this, if the price of gold is going to go much higher, and these companies have alerted the marketplace, I don't care if you're looking at New Gold, Pan American, Silver, Wheaton, Newmont Mining, Barrick, all of them have said if the price goes up, we're going to raise our dividends. But Dave, if that happens and they can continue to go up, do you think we reach a point where a shareholder or a potential investor says, wait a minute, I can go into the silver ETF or GLD, which in case I'm buying just paper, and you hope the gold and silver is there to back it, or I can go into a stock like Newmont or Pan American or Silver Wheaton, get a dividend yield that's equal or greater than Treasuries that's growing at almost 20-something% a year.
Totally agree with you, Jim. I said something like that at an interview I did on television up at the Vancouver conference, Vancouver, British Columbia conference in January. And I said, Wall Street, basically, the good guys, there aren't any on Wall Street, I'm making a joke here, there's a few, but they look at earnings. And the earnings on these companies are tremendous, but they're usually behind the curve. A lot of the analysts that maybe know this stuff just aren't allowed to or don't speak up. A lot of people that read the Morgan Report will be in these stocks once Wall Street discovers their quarterly earnings are up and up and up again. And then they'll come into these stocks, whereas people that read reports like mine and others, you're going to be in these stocks at the right time, which is now, and then Wall Street will catch on later. So I really think that's a huge bonus. The only caveat I have to give about it is that there's this proposal for increasing the tax on dividends, which is rather substantial. And there is a way, I would say, around that, but it's extremely cumbersome, and that would be to pay the dividends in the underlying metal. In other words, if you're a gold corp or a Newmont, you could pay in gold, and if you're a silver company like Pan American, pay in silver. It's not as cumbersome as it looks, because there are ways that you could go into like a holding company such as the Gold Money, where, of course, the shareholder would have to have an account there, obviously. And I'm just giving a general idea. But I think you're going to see that take place at some time in the future, Jim, where because in today's electronic world, and you can pay in grams of gold or grams of silver, for example, if you could have some type of holding company, you could actually have the ability to pay out in the underlying commodity. I think that would really be something that some of these forward-thinking companies might start to think about, because there's a way to do it. Again, the first one to do it is going to have a lot of red tape, but once it's accomplished, there'll be others that'll follow.
It's amazing. You mentioned this payment of dividends in the form of bullion itself, and I know there's a couple companies that are now proposing this. I mean, Dave, if we look at, as investors, why we own gold, and I think those that have been in this market for the last decade, bought bullion or bought shares, know that there's a reason they're buying this, given the monetary debasement that we're seeing occur globally. And what better way, if you want to accumulate gold or silver, is to buy a company that mines it and pays you in the form of bullion in their own product? I think that could be a big booster.
Absolutely. If you go back, as you well know, Jim, Rob McEwen, when he was forefront at Gold Corp, I was with him in Chicago, and I said, geez, I really wish some silver companies would take on this, holding some of your production in bullion form and keeping it in a vault, and that being a double investment for investors at that time. In other words, you owned Gold Corp shares, but you also had a bullion position because the company itself, Gold Corp, actually held gold bullion. And I know that Eric Sprott has mentioned silver companies should try something along those lines. Actually, it was done. I was one of several that were proposing that companies look at that on the silver side, and Silver Standard actually took it up by a lot. By a lot relative to an individual, relative to their balance sheet, it wasn't that much, but that's another way to do it.
Also, I know that Sprott Asset Management has been urging some of its largest producers that are saying, look, if you are generating more cash flow than you need to spend, and we think the price is being suppressed or artificially low, pull a Rob McEwen. If you're selling 1 million ounces and you only need to sell 600 to pay your bills and capital expenditures, withhold 300,000 or 400,000 ounces, put them in the bank, and watch the price appreciate. So it's, even very astute investors like Sprott are telling their mining companies, hey, if you want to do something about this, don't sell your product at low prices. So sooner or later, Dave, you would think that this would catch on. Here's something that I want to bring up, and you and I have talked about this issue in the past, and that is right now, even though they can knock the price of gold and silver down, one of the reasons they're losing the battle is every time they do that, the phones ring off the hook at bullion dealers because people see it as something they want to own that's been put on sale. But Dave, you and I have talked about this, and especially with the oversized trading that occurs in the paper market, that at some point in the future we're going to see a default on the exchange, and there's been a default on exchanges in the past. And the fact that investors just say, don't trust the paper market, and they try to get bullion, where we reach a point where getting bullion is going to be hard to get. I remember my own example in 2008 when they drove the price down to $9 on silver, and I bought a lot of silver, and I had to wait 3.5 months. But do you foresee that day happening? And if that day does come, which I think in my own view is coming, that investors say, okay, it's harder to get the bullion, I might as well get the next best thing. I'll buy shares in a company that produces the stuff and pays me in bullion.
Absolutely, and that's two great questions. I just came back from the Texas Precious Metals Conference in Dallas, and my friends that invited me to speak met with Kyle Bass, who's quite famous for being on the correct side of this mortgage debacle. He's there in Dallas, and he's a bit of a gold bug, I'll add. But I really do think that most people don't understand how the bullion market works on the retail level, which means there are very few wholesalers, and all the retailers that most people deal with buy through that dealer, and the dealer actually doesn't hold the metal. In many cases, it's drop shipped from the wholesaler. So they'll back order. In other words, when things were going crazy in 2008 and there was a big delay in the chain, what was taking place was dealers were taking orders for inventory that really didn't exist. And they were depending on the wholesalers to come up with that inventory at some time in the future. So that's how tight the market was at that time. And I believe the trend will continue. So there could be a day on the physical side where there are dealers that are willing to take the risk, in other words, promise delivery of a product that's very difficult to get that may turn out to be impossible to get. I'm not predicting that will happen precisely or when, but I believe it could happen. I believe in certain cases we've already seen it happen. And so, as you said, this follow-on part was, well, wouldn't it be advantageous to own a company that would pay you in the metal itself? And the answer is absolutely. And I'll add on to that. I think what's going to take place from not this point forward, but probably 2013 or so forward, will be that we'll see the metals prices back up higher in paper price. So let's pick some numbers just for talking purposes. Gold will be well above the $1,900 level, so it'll be in the 2000s somewhere. Silver will be above the $50 level and maintaining that price at some point, so we'll round it up to, say, $60. And a lot of people that were thinking about getting in today, listening to the show right now, but are just going to watch it like it's an entertainment exercise rather than something they need to take action upon, we'll decide then that, you know what, these guys are right, gold and silver is the way to go, but I don't really want to buy gold and silver. I'd rather buy the shares. And once the Wall Street folks catch on, especially as you outlined with these high dividends being produced on these major companies that are very solid and growing, you'll see the mid-tiers and the juniors catch up rapidly because these people that are waiting on the sidelines now will be jumping into these shares like crazy. We saw it happen in the 1979 run-up, the final wave, the final parabolic move in gold and silver. The shares went absolutely ballistic, and I think it's going to happen again, Jim, because there's going to be a lot of people that are going to be late to the party, and they look at their retirement, they look at their savings, they look at everything, and gold and silver really attracts a lot of momentum players, even though they don't think of themselves as momentum players. It's an emotional exercise. They think that there's the last train out and they better get on board or they're not going to miss it. There'll be a lot of people. And a lot of people will not take the effort or time to buy physical metal. They can get on their E-Trade or Scottrade or Ameritrade. I don't leave any of these companies out, but some electronic trading platform. They can look up any stock they want. They can press their mouse and they can buy shares. So I really believe that these shares are going to catch up and then some over the next several years. But I don't think it's going to start this year. I think we're more likely to see that scenario take place between 2014 to 2016, something in that range.
Yeah, because I remember, Dave, and you take a look at the amount of money that's in mutual funds. We're literally talking about tens of trillions of dollars. And I remember in the technology bubble in the late 90s where it was not unusual between 97 and 2000 to look up the holdings of some of the nation's largest mutual funds, and I couldn't believe the overweighting to technology. And we have to remember, and our listeners have to remember, you take an average fund manager, he is more accustomed to buying shares of a company. He can analyze a Newmont Mining. He can look at it from valuation perspective that he understands, PE ratios, dividend yields, price to cash flow. I mean, that's a yardstick that he can measure in terms of profitability, and that's something he's used to dealing with. If you look at bullion itself, how is he going to measure that? How do you look at the price of gold and say, well, on a PE metric, gold should be selling for X amount? And that's why I think that eventually the fund business will gravitate to any kind of sector that outperformed. I mean, take a look at individual investors. They were absent the stock market until 1995. But when 1995 hit, after almost a 13-year run-up in stock prices, all of a sudden the individual investor came on board, and look what happened from 95 to 2000. Dave, as we close, let's say our shareholders would like to follow your work or keep abreast of what you're doing at the Morgan Report. How can they do so, please?
Well, there's several ways. I think the easiest way to just follow our work is go to our Twitter feed, which is SilverGuru22 on Twitter. And if you can't remember that, just go to Google and type in David Morgan Twitter, and you'll find it. Also, the YouTube channel is Silver Guru. On the website, silver-investor.com, you can get on our free weekly email list. And if you're more serious about investing in these markets, you can try 1 or 2 or 3 levels of the Morgan Report: beginner, intermediate, and advanced.
Dave, thanks for joining us on the program. As always, it's a pleasure speaking with you. We appreciate your input. Come back and talk to us again.
Thank you, Jim.